All right, so first thing that I want to do is just get you to think a little bit about how the market has changed over the last 12 months, and the impacts of that are going to come through in 2017. So the first one that I really want you to think about is the recent law that has come in, which is the stamp duty, and how that's going to impact property investors and property investment decisions. All right, we'll talk about regulation and also the impact of Section 24, and then I'll give you some thoughts on what I think the market's going to do and some ideas for you to adapt and take profit from it. So first thing is stamp duty. Now this graph here that I'm showing you up here is the number of property transactions that are cleared through Land Registry every single month, okay, going back the last couple of years. Now what you will see is around April we had a massive change in March, okay, for the number of transactions, and the reason is because from the 1st of April the law was changed that everybody that was buying an investment property would have to pay an additional 3% stamp duty. So you can see that the massive amount of transactions that took place prior to that, and lawyers working 24/7 trying to get transactions through, and then correspondingly the deals the next month falling down. Now what you will see is clearly that the number of transactions that have come through in the following months has dropped. Okay, so what you are going to see now is investors are having to think much more about their cash in doing transactions. Now, the reason that this came across is because the government decided they wanted to allow first-time buyers to have the opportunity to get onto the property ladder, and by penalising or surcharging, whichever way you want to do it, for property investors. The impact that has had is that the Inland Revenue is actually collecting less stamp duty now than it was at the beginning of the year. Right? So the problem is when you put up prices, sometimes you can get away and still collect more revenue, but what ends up happening is people make decisions and literally pull out of the market. So what I think is going to happen is, we'll talk a little bit about that, but the government has got to collect a certain amount of stamp duty, and so it's got to decide whether it's going to subsidise first-time buyers by not allowing investors to buy, and the slack has not necessarily been picked up by first-time buyers, because the reality is what first-time buyers look for and what investors look for are very different markets, right? But politicians being politicians, all houses are treated exactly the same, and they'll go for the voters, and unfortunately politically landlords are a minority in the voting population, so we'll always go for the voter, because in this country we have one person, one vote. Yeah, so we need to look at that, because what's happened at the moment is everyone is kind of sitting, waiting, yeah? And you need to factor in the fact that the stamp duty laws will take maybe some time to change. They may not change, but we'll have to see what happens there. The other thing is that buy-to-let is going to get continued regulation, okay? So now I'm going to go into a little bit of technical stuff, but you do need to make yourself aware, and certainly you should be having discussions with whoever is providing your finance on the criteria that you're going to be using when looking at a buy-to-let mortgage, okay? So what's happened? Well, the Bank of England have given all mortgage lenders, okay, a criteria for buy-to-let in what is called stress testing. So when you apply for a mortgage, you will be looking at what your monthly interest costs are, okay? And that in the mortgage terms is what's called the pay rate. That is what you pay every month when you borrow. But what you need to understand is that the mortgage lenders, when they're looking and reviewing your application, they are not going to be looking at your affordability based upon the rate that you're paying. They're going to actually do what's called a stress test, which means it must pass a base rate cost of 5.5%, right? So that means that every time you look at affordability, the rent has got to work on calculating 5.5%. The second thing is what's called the interest cover. Now, back 5 years ago, mortgage companies would ask you to cover what's called 125%. So what that meant was that around 80% of the rent could go towards the interest payment. But now, they're going to factor in additional costs, which is this tax coming in. You need to look at calculations of 145% rent cover. Okay? Now what that means is that the rent that you've got has got to be discounted by 1.45% before you can work out the interest. And the second thing is the interest rate is not the pay rate, but this new calculation of 5.5%. Okay, so what does that mean? It means that when you're looking at the rent, the mortgage company is going to want a higher yielding to be able to work out how much they're going to lend to you, all right? So the bottom line of that comes down to is, if the property that you are looking to buy or at some point refinance, because it doesn't necessarily mean at this point, all your remortgages, so even if you have existing property, right, the terms that you had 2 or 3 years ago, you will find that when you come to remortgage, okay, the market is going to want you to change the parameters. So even if the value of the property's gone up, okay, you can end up in a situation where you're going to have to put money in to be able to refinance to continue at the rates you have or pay a higher rate. So if you have properties that are low yielding, under 5%, then these two numbers are going to be quite critical to you. So what you want to look at is look at every single mortgage application that you've got either in the pipeline or going forward, and you need to future calculate on these numbers. Now, what I've always said is you should always work on 150% and 5.5. So these two things, which we predicted last year, right, are coming true, because 2 years ago it was less than 5% and it was 125% interest cover. All right. Now that means that people are going to have to look at alternatives and may even end up selling and disposing of their property because they won't be able to refinance. And you can get what's called the SVR trap, okay, which means that people who got 1, 2 year, 3 year discounted mortgages are stuck now because when they come to refinance, they've got this dilemma, okay? And the dilemma is, do we find the extra money to be able to refinance down because the amount that we were borrowing before we can't get, right? Or we get stuck on SVR, okay? And SVR is standard variable rate, which is always generally for most lenders the most expensive rate, okay? So you're going to see a lot of people who haven't sat down and thought about the remortgaging options of their properties. Yeah, okay. So I want to make sure that people figure out what they can do to avoid that. So what's going to happen is the upshot is going forward, you are going to see that you're going to need more cash to do certain types of deals. So everyone thinking that it's a 25% deposit is usually okay if you've got a high yielding property and you can cover those two rates, so the 145% interest cover and an interest rate of 5.5%. All right. So that means that single family lets, okay, for buy-to-let investors are actually in certain areas going to become unviable unless you have a bigger deposit. Okay. So what you need to do is you need to factor in 2017 two things. Number one, my deposit is going to be larger than the typical deals that I've done in the last couple of years, and the amount of cash, because no bank yet exists to lend you the 3%, okay? So you need to factor that in. So when you come to working out in today's market and next year's market, deposits of 30-35% are going to become quite typical in terms of the cash that you're going to require as a percentage of the purchase price, okay? So what that means is you've got to figure out more creative ways of getting that initial deposit and then covering your interest costs. Do not look at your interest costs just being what is the headline number that the mortgage lender is giving you, okay? Because that, don't confuse the pay rate as being the calculation that you need to look at. You need to look at these calculations, and all lenders, I'm going to go back to this slide, all lenders are eventually going to move to this. Okay, so what that means is the calculations that most property investors have been using for the last 10 years, those have all moved the other way. Okay, the cost of the base rate has gone up and the interest cover. All right, so you need to make the viability of paying the interest every month and the calculations, even though you won't necessarily have to pay it, because kind of confusingly, mortgage lenders are lending at a very low rate, but the government has forced, and the Bank of England has forced, everyone to say we can only lend to people who can afford, and the deal can afford, if base rate went to 5.5%, and you can cover 150% of the cover. All right? So, the other thing is that, does everyone understand the MCD that is going to be implemented in the next few months? Okay? So, this is another sort of paradox. Because of Brexit, we are going to leave the EU, but the Bank of England has said that for the majority of all the EU directives around financing, they have decided that they're going to adopt them and then individually decide whether those will continue as part of the Brexit leaving structure. So what that means is this, that landlords who became what we call accidental landlords, if they bought a property that they were originally going to live in, okay, and then went and got consent to rent it out because they found a person that they fell in love with and they wanted to go and buy another place and they wanted to rent that out and they got consent, there will all have to go through again on remortgage or reassessment that they fully qualify as a professional property business and that you have got your affordability. So, buy-to-let has not had to do the same thing that consumer mortgages have had to do, which is lifestyle. Not only do they want to know how much you earn, but where do you spend your money. So now, buy-to-let lenders are going to have to kind of go through that same process of not just what is the rent, because that's the only question, and what's the value, but also what are your expenses and your ability to do it as a business, okay? So what this means is that you are going to have to go through other regulations and prove that you are doing the necessary expenses. They're not just wanting to know what the rent is and then what your interest cover is. They'll also may analyse all your other expenses there and that you are running it as a proper business. Okay? And a lot of people are not aware, and they think that because we're part of the Brexit situation and leaving, that none of those EU laws are going to be adopted. The Bank of England and the Financial Conduct Authority have clearly stated that they will continue implementing all of these EU directives, irrespective of what happens with the situation with Brexit. So what you have to do going forward is not just look at your financial situation today and assume that your lenders are going to continue, because all of these things coming in are going to make a big impact on how you analyse a deal. Okay? Because what's important for investors in the room today is don't just look at what the financing that's available today. You do need to think about all these situations that are going to come in, and they're going to become mandatory across all the mortgage lenders and finance lenders that you're going to be working with. So what you need to be thinking a little bit is what is the calculations that you're doing in calculating a deal? Don't base it on market conditions today. Really future-proof yourself next year or two. Figure out all the implications that are coming in and work on that deal so that in 2 or 3 years' time, your deal that you purchase next year will still stand on its own 2 feet based on financing situations, and that you won't then end up in a situation 2 or 3 years later when you come to look for new financing that you find you've painted yourself into a little bit of a corner. Yeah? Okay, so Section 24, everyone aware in April that that's going to be coming in? Yeah? All right. Now, what does that mean? That means that as of April in 2017, you will not be able to account 100% of all the mortgage interest if the property is in your own personal name. Okay. And what we recommend is that you start now thinking about ideas and strategies of either incorporating or dealing with that situation, because that will have a big impact again on your taxation. And you need to figure out how you're going to do that, because this is going to be an ongoing situation that will continue. All right. So let's talk a little bit about predictions. All right. So first prediction that I think is probably not likely to happen. I know a lot of people are just going to stick their head in the sand and hope and pray that the problem will go away and that some meticulous situation will occur. So you need to understand that Section 24 is actually real. It's going to happen, all right? And what you need to be more doing is paid. Now, what they are going to do is they are going to phase that in, okay? So that will be from April 17 to 2020, all right? So that's going to happen in a slow, steady way. So what you need to understand is, bottom line is that your interest amount that you can write-off against your rental income is slowly going to decrease, and that will eventually only get down to 20% for basic taxpayers. All right, and then what you need to understand is that I suspect what will happen over the next couple of years is that there will be some changes with the implementation and new rules. So there will be some concessions, just like the stamp duty, where the government thought it was a great idea and it's going to collect more revenue in. They are going to make some adjustments. So what I think will happen is in the next couple of years, there will be some cases where they will give some exceptions to do that, because the onerous part will be that some landlords, and landlords already are doing this, because why this is important is for a bunch of landlords, they're just going to say, do you know what, I've had my money, I've made it, now is the time to exit, I don't want to deal with all this regulation, and they're going to be selling those properties. They won't all happen in one massive wave, but it will steadily happen, okay? So what will happen is, for new landlords, there is an opportunity to come in, but you need to make sure that you have got your financing situation and your calculations. What you need to figure out is that your deposits and your working capital that you're going to need for each deal is going to have to be larger. So you do, maybe like Nicole, go out and raise capital or work with other people, okay, to make your deals viable going forward. All right, so the 3% surcharge being scrapped, I think that that's got more legs on itself, okay? Already, we're only 6 months into the law being applied, and the government are already having consultations with various people. So I don't think you will see that suddenly go straight out or change in this autumn, but sometime next year, I definitely see the government relaxing that a little bit and encouraging landlords to continue to buy, because they do still need the housing situation that landlords provide. So I definitely see that there will be some changes around that, which will be good for you, and that will get the buying machine active back again. Okay.